Hey everyone, welcome back to the channel. Today, we're diving into a super important topic for anyone just starting their investment journey, mastering your first portfolio. It can feel a bit overwhelming at first, but trust me, with the right guidance, you'll be building your wealth smartly in no more time. We're going to cover the most common mistakes every beginner makes and, more importantly, how you can avoid them. So, grab a notebook, and let's get started on building your financial future. First up, the biggest mistake is not having a clear plan. It's like setting off on a road trip without a map. You wouldn't do that, right? So why do it with your money? Before you invest a single dollar, ask yourself, what am I investing for? A house? Retirement? A dream vacation? Your goals will determine your strategy. A short-term goal requires a different approach than a long-term one. So, take a moment, define your financial goals, and write them down. This simple step is the foundation of your entire investment plan. The next pitfall is putting all your eggs in one basket. You've probably heard this before, but it's incredibly true. Maybe you heard a hot tip about a tech stack and you're tempted to go all in. Please don't. This is called a lack of diversification, and it's a surefire way to expose yourself to unnecessary risk. If that one company hits a rough patch, your entire portfolio suffers. Instead, spread your investments across different asset classes like stocks, bonds, and maybe even real estate. Within stocks, diversify across various industries and company sizes. This way, if one sector is down, another might be up, helping to balance out your returns and protect your capital. Another classic rookie mistake is letting your emotions take the wheel. The stock market is a roller coaster of ups and downs. It's totally normal to feel a bit of panic when you see your portfolio value drop, or to get greedy when things are soaring. But making decisions based on fear or excitement is a recipe for disaster. This often leads to selling more and buying high, the exact opposite of what you want to do. The key is to stay disciplined and stick to your long-term plan. Remember those goals you set. They are your anchor in a stormy market. Don't check your portfolio every 5 minutes. Trust the process and let your investments grow over time. Okay, let's talk about fees. This is a sneaky one that can eat away at your returns without you even realizing it. Many investment funds and platforms charge fees for their services. While some fees are unavoidable, high fees can significantly reduce your long-term growth. Imagine paying an extra 1% in fees each year. Over 30 years, that can add up to tens of thousands of dollars. So, before you invest, do your homework. Look for low-cost index funds or ETFs. Compare brokerage platforms and understand their fee structures. A little bit of research here can save you a lot of money down the road. Now, let's talk about timing the market. This is the idea that you can predict when the market will go up or down, and buy or sell accordingly. I'm here to tell you, even the most seasoned professionals can't do this consistently. Trying to time the market is basically gambling. A much more effective strategy for beginners is something called dollar cost averaging. This means you invest a fixed amount of money at regular intervals, say, every month. When prices are high, you buy fewer shares. When prices are low, you buy more. Over time, this averages out your purchase price and removes the stress of trying to find the perfect time to invest. It's a simple, powerful, and disciplined approach. A huge mistake is ignoring the power of compounding. Albert Einstein supposedly called it the eighth wonder of the world, and for good reason. Compounding is when your investment returns start earning their own returns. It's a snowball effect that can turn a small initial investment into a substantial sum over time. But it needs one crucial ingredient: time. The earlier you start investing, the more time your money has to work for you. Don't get discouraged if your portfolio growth seems slow at first. Be patient, stay consistent, and let the magic of compounding do its thing. Starting in your 20s versus your 30s can make a massive difference in your final retirement nest egg. Finally, the last mistake to avoid is not continuing your education. The financial world is always changing. New investment products emerge, economic conditions shift, and your own financial situation will evolve. Don't just set up your portfolio and forget about it. Make a habit of reading financial news, listening to podcasts, or following reputable creators right here on YouTube. The more you learn, the more confident you'll become in managing your money and in making smart decisions. Your financial literacy is one of the best investments you can ever make. So, to recap, have a plan, diversify your assets, control your emotions, watch out for high fees, don't try to time the market, start early to harness compounding, and never stop learning. Avoiding these common mistakes will put you light years ahead of most new investors. Building your first portfolio is an exciting step towards financial freedom. It's not about getting rich quick. It's about building sustainable wealth over the long term. If you found this video helpful, please give it a thumbs up and hit that subscribe button for more content just like this. And don't forget to ring the bell so you never miss an update. Thanks for watching, and I'll see you in the next video.